thank you for taking the time to listen to our show today. I'm Jason MacGegor. I'm the host of the MacGegor Wealthcast. Each episode, we will be discussing topics we believe to be important to our clients.
And welcome to our podcast this week. Hi, everybody. This is Jason MacGregor. I'm one of the owners of MacGregor Wealth Management, and welcome to our podcast. Today, I'm joined by Cory Laird.
Good morning, good afternoon, good evening.
Cory's a certified financial planner, and together we help clients on all things investment management and financial planning. And today we want to talk about interest rates. If you are watching or hearing the financial services news, there's been a lot of talk recently about interest rates. And in general, the interest rates are going higher. And we're going to talk about what that means. We're going to talk about how that may impact inflation and recessions and economic expansions. And we're going to talk about how that may impact stock and bond market. We're going to wrap it up by talking about what it all means to you, the general public listener. So let's just start by talking about interest rates in general. When we talk about interest rates here at MacGregor Wealth Management, we're primarily looking at the 10-year Treasury note. And the 10-year Treasury currently, on March 18th, 2021, is at 1.75%. And that's increased quite a lot in the last year. If you look back at a chart of the 10-year Treasury going back, 9, 12 months, it was in like the 0.5 to 0.6 range as recently as July of 2020. So that's less than a year ago. So that's a fairly, in our world, in the bond market world, that's a very dramatic rise in a relative short order. So there's lots of different interest rates out there. As a saver, you might be thinking about your bank accounts. You may be thinking at something about your mutual funds or ETFs. There's a lot of interest rates in the bond market. It's a massive, massive market. But we want to focus today about talking about the impacts of a rising or falling 10-year Treasury note. So, Cory, I'll tee it up here for you and ask you, what I think is a pretty simple question. What impact does it have if someone's a borrower or general public? What does higher 10-year Treasury do to them?
So you got to think about that borrowing you pay in interest rate, and that's what it comes down to. The 10-year Treasury that the federal government issues or is issued to them is affecting the other interest rates in the market. So it's affecting your mortgage rate, it's affecting your car loans. So when the 10-year interest rate is increasing, then your mortgages are increasing, your car loans are increasing. So basically, when you're borrowing money and interest rates are increasing, so is your borrowing cost. And I think that's really the thing that will affect a lot of people. And that's why you see a lot of the house prices increase. People are building a lot of houses, buying new ones, because historically speaking, in the last year or so, interest rates have been very, very low. And so people are getting that new mortgage, that new house with the low interest rates, and they've gotten it real cheap. Now, with interest rates increasing, I think this is really going to affect a lot of people who are looking to buy that next house or get that new mortgage or that new car loan. With interest rates increasing, it actually might make you not want to do that anymore. If interest rates are increasing, it's going to make your borrowing cost $200-$300 more per month. You might not do that, and so you may not buy that next house and new car because interest rates are increasing.
And the other thing about interest rates is if you are borrowing money and your interest rate, the cost of your interest is going higher, then your discretionary income is less. If your payment goes from $1,000 to $1,200 a month, and that's $200 less that you then have to spend on consumer goods or to put back into the economy. So a negative impact of higher interest rates are slowdowns in certain sectors of the economy, and also less consumer discretionary income. And the stock market, and we'll talk about the impacts of the stock market later, but that is a worry. Now, a positive side isn't really related to the 10-year Treasury, but a lot of our clients are bank savers, or they have money in the banks. And this is a short-term interest rate thing. And in general, there's a lag between when banks start to raise interest rates versus on what they're paying you on their deposits versus what they are lending the money at. They're very quick to raise those rates, and there's a lag because they keep the spread. That's why you've seen bank stocks do well lately because excuse me, as interest rates go higher, then the amount of margin or spread that they can make increases. So for years now, we've been in a very historically low interest rate environment. Mortgage rates are still very low. Home equity rates are still very low. But relative to where they were 6 months ago, a year ago, they are higher. Now, unlike the stock market, where you may have large swings intra-year, up 5%, down 7%, down, up 10%, the bond market in general is a much slower moving, I like to call them like super cycles. The rates go down for 10 or 15 years, then there might be a little bit of oscillation back and forth, but then they in general start to rise for a number of years. And you will hear a lot of discussion about the Federal Reserve or what the government is doing to try to influence interest rates. So they're thinking about how to keep or get us out of a recession. We are still in a recession. And also how to manage inflation. So let's talk about inflations and recessions because and the impact that interest rates have on them. So which came first, Cory? Inflation or higher rates?
That's pretty much uncertain. In fact, a lot of them are affecting the other. So the main tool that the Federal Reserve has to combat inflation, higher inflation, is higher interest rates. If inflation is increasing, it may cause a hyperactive increase in the economy, which is actually, it sounds like it's a good thing, but it's actually a bad thing. Think Argentina, think Venezuela. These countries had hyperinflation, in the 10 to 20% range or higher for Argentina. So there's an issue there in terms of higher inflation that the Federal Reserve wants to combat. And their main tool is to increase interest rates. They don't want to increase interest rates, but if they feel like they have to combat higher inflation, that's really the only tool that they have. So with increasing inflation, you got to think it's probably going to happen this year. Inflation's increasing because what are we doing? We're all getting out there and we're all spending. People are getting more vaccines. They're all going out. Restaurants are opening. That is going to increase prices. Higher demand of something will increase the price of that something. And so if prices are going up, that's the definition of inflation. So we we certainly expect inflation to probably close to double this year, maybe even more. The Federal Reserve is not looking at the short term. They're looking at the long-term inflation, but they are certainly looking at the inflation, how it affects the recession, and getting everything back open.
Sure. And then remember that there is a disconnect. There can be a disconnect between what the Federal Reserve is doing to artificially keep shorter-term interest rates low and the 10-year Treasury. They will work independently of each other. The Federal Reserve has been very forthcoming for seems like years now that they're going to artificially try to keep the short-term borrowing costs down. But despite that, the 10-year Treasury has increased quite a little bit, as we've said a couple times. So, just remember when you hear about the Fed funds rate and what the government's doing to artificially keep interest rates lower, that doesn't mean that the 10-year Treasury is going to remain low because it's a much more forward-looking instrument that's dictated by the capital markets.
Right.
So we've talked about the negative impacts of inflation and what the government can try to do to manage that. And as our clients and prospective clients are listening, they're probably thinking, okay, how does this impact my stock and bond holdings? And I like to say that if you think about the capital markets, and there's a finite amount of money out there, and if you're an investor, you're seeking returns, you're seeking growth of your money, and you have options. You can leave your money in the bank, which 25 years ago were paying you 5 and 6%. You thought that was probably pretty good, and now it's paying point nothing. You could invest in stocks or bonds. You can invest in real estate. You can invest in commodities. So you look around the world and say, okay, where can I get growth? And we get calls pretty much daily from clients and prospective clients who say to us, during COVID, we've saved a bunch of money because we can't travel, we haven't been spending, and I've got all this cash piled up and my bank's not paying me any interest. And they're probably not going to pay any interest for a long time based on my previous statement of they're slow to raise short-term rates. So they say, okay, well, if I can average, if I have a balanced portfolio, can average 4 or 5%, that sounds pretty good because, that's going to outpace inflation and keep my purchasing power in the positive territory. And as long as you earn more than point nothing, you're ahead of the game. Well, the risk is if the intermediate and long-term rates continue to rise, that could negatively impact the stock market in that when we get back to the government guaranteeing you 3 and 4% on intermediate and long-term bonds, you might pause and say, you know what, maybe I don't want to put my money at such risk in the stock market, and maybe I am okay with earning 3 or 4 or 5% if the government's guaranteeing that interest rate. So there's this competition for your money, and I don't think we're at that tipping point yet, but if we look out forward here in the coming years, that could be a potential problem, and that's when people are saying to themselves or saying, okay, why isn't the stock market going up, or why is it going up? Interest rates can have a material impact on it. That's the stock market. The bond market, huge market as I mentioned. Cory, what is the impact of higher interest rates on traditional intermediate and long-term bonds?
You got to think of them as opposites. So what ends up happening, let's say you own a bond that's paying you 1.5%. And let's say that bond interest rates go up to 2%. And you're sitting there getting your 1.5%, and you see there's bonds at 2%. Well, what are you going to do? You're going to sell your bond at 1.5 and go out and buy yourself a 2% bond. Well, you and everybody else is doing that. So when you sell something, price goes down. So when interest rates go up on a bond, prices on those bonds go down. So they are opposite. So generally speaking, when interest rates are increasing, then bond prices are declining. Now, as Jason mentioned, there is a tipping point that when bonds usually get to a certain point, you start seeing a little bit of an increase in the price because people are going from stocks to bonds. They are saying, I'm okay with 4% interest rate. That sounds pretty good to me. It's a lot less risk. And so they go from stocks to bonds, and there's a slight uptick in bond prices because of that higher buying power. And then there's a slight decrease in stocks. And frankly, you don't see this usually in one day. It's usually a gradual movement of money over time.
Yeah, so that's that classic inverse relationship between bond interest rates, or I should say, classic inverse between interest rates and bond prices. Higher interest rates, lower prices, and vice versa. So if you take any, that's interest rates 101. So remember, there's an inverse relationship. Now, that's a super simplistic explanation. The capital market, the bond market is a massive market. There's lots of different types of bonds, and the things that we're, what we would advise our clients and people who are listening to do is, the things that you can do now. Okay, so if you agree, or obviously interest rates have risen, if you think that that ship has left port and it's going to continue to do that in the coming months and years, then there's a couple of things that you can do right now to take advantage of it, or to take advantage to protect yourself. One is, if you have any type of variable rate loan, then you may want to consider checking out what your lock-in rates or what your lock-in rate options are. Variable rate loans have been very popular as interest rates have gone down over the last 10 years. So in the coming years, what you're paying on now at 3%, like a home equity line of credit, maybe at 4 or 5%. And again, if you do an amortization calculator and you do the math, that can be a substantial amount of more money that you're paying in interest on your variable rate loan. Review your bond holdings. We're talking about this inverse relationship with bonds and interest rates. Not all bonds are created equal. There are bonds out there, and we're not going to get in the weeds of too much here because this is a whole other podcast. We could probably do a whole other conversation. about the nuances of all these different bonds, but there are actually some bonds that are less interest rate sensitive than others. You can shorten the maturity, you can shorten the duration. There are some bonds that are more highly correlated to interest rates, meaning as interest rates rise, they can actually appreciate. So just a review of your bond holdings is what we recommend, because again, over the last 10 or 15, even 20 years, as a super cycle of interest rates have been going down, you've benefited by not only are you getting the coupon or the interest every year, but you've had some appreciation. So it's easy to kind of just forget it, set it and forget it. Well, now is the time to look at that. And lastly, if you are sitting on a lot of cash probably isn't going to pay much for quite a little while. And looking for something that's going to keep pace, if not outpace inflation, is advisable. So a couple of good reasons to have conversations with us. If you have any questions, this today was a real high-level overview of how interest rates work, why it's in the news, why in the coming months it will probably continue to be in the news. But as always, we thank you for your time listening. If you have any questions, we can be reached at 518-499-4565. Our website is mmwealth.com, and we can be reached at email at info@mmwealth.com. So thanks again. Hope you enjoyed yourself. Talk to you soon.
MacGegor Wealth Management is registered as an investment advisor with the SEC and only transacts business in states where it is properly registered or is excluded or exempted from registration requirements. SEC registration does not constitute an endorsement of the firm by the Commission, nor does it indicate that the advisor has attained a particular level of skill or ability. Information presented does not involve the rendering of personalized investment advice and should not be construed as an offer to buy or sell or a solicitation of any offer to buy or sell the securities discussed. Different types of investments involve varying degrees of risk, and there can be no assurance that any investment or strategy will be suitable or profitable for an investor's portfolio. There are no assurances that an investor's portfolio will match or outperform any particular benchmark. All investment strategies have the potential for profit or loss. Past performance may not be indicative of future results. The tax and legal information contained in this podcast is general in nature. Always consult an attorney or tax professional regarding your specific legal or tax situation.